Welcome to the Daily AI News Digest. Today is June 24th, 2026. I'm your host for today's Explainer, where we track the latest structural shifts across the technology sector. This broadcast is sponsored by bestai.org. Let's get right into today's market realities. On the rundown for today's Explainer, we're covering a major semiconductor market correction, some massive global supercomputing shifts, DeepMind's newly published roadmap for superintelligence, and the infrastructure deals currently shaping the regulatory landscape. Then we'll wrap up with our analysts' take. First up, let's look at the macro events and the very real market corrections currently hammering tech equities. Right now, the financial markets are undergoing a severe stress test. Overnight, a massive wave of selling hit technology equities globally. The Philadelphia Semiconductor Index saw a really sharp drop of 7.9%, and the broader NASDAQ composite fell 2.21%. So what's driving this? Well, it's primarily coming from mounting investor scrutiny over the sheer scale of debt-funded capital expenditures, the CapEx required to build out global AI infrastructure. And when you combine that with a hawkish interest rate environment making that debt significantly more expensive, the market gets anxious. And we saw this sell-off cascade rapidly right through the supply chain. Over in Asia, Samsung and SK Hynix took double-digit hits following reports that memory expansion for advanced AI chips might actually be slowing down. That sentiment immediately spread to Wall Street. Micron technology tumbled 13%, and Intel saw an 11.28% decline. What we're observing here is a market firmly demanding verifiable returns on the massive capital currently being deployed into hardware. Meanwhile, the physical reality of compute is scaling relentlessly. The 67th Top 500 list confirms a major shift in the global hierarchy. China's new LineShine system has officially taken the #1 spot, delivering 2.198 exaflops. That means it's capable of over a quintillion calculations per second, unseating the US-based Capitan system. But you really have to notice the power consumption here. LineShine requires 42.2 megawatts of power, literally enough to run a small city, compared to Capitan's 29.6. The architectural choices behind LineShine are also highly specific. It's built entirely without GPU accelerators, relying instead on nearly 13.8 million custom ARM v9 CPU cores. Now, while this system absolutely proves a high degree of domestic self-reliance and component manufacturing for China, the architecture reveals a clear trade-off. In mixed precision benchmarks, which are the gold standard for AI workloads, LineShine lands only in 4th place. Basically, it's a machine built for traditional 64-bit scientific computation through sheer scale and electricity, rather than true AI-optimized efficiency. Moving beyond immediate hardware constraints, let's map out the verifiable, long-term technological horizon. Google DeepMind just published a highly detailed 57-page structural analysis titled From AGI to ASI. This is a 30,000-word document that purposefully moves the conversation past human-level artificial general intelligence, or AGI, and attempts to map out the formal continuum toward artificial superintelligence, meaning systems capable of outperforming large organizations of human experts over extended periods. The report clinically outlines 4 parallel mechanisms for reaching this milestone. First is sheer scale, so increasing compute, data, and model sizes. Second is algorithmic paradigm shifts. Third, recursive self-improvement, which is where systems autonomously optimize their own code. And finally, multi-agent coordination. It's important to note these aren't just wild predictions. They are the formal academic pathways structuring today's research. Turning our focus to the business desk, we're looking at how the biggest players are structuring their balance sheets and navigating policy. Today's most significant institutional transaction comes squarely from the infrastructure sector. SpaceX has finalized a compute agreement with Reflection AI, which is an open-source AI startup, and this comes with a total nominal contract value of $6.3 billion. Under the terms of this deal, Reflection AI is going to pay $150 million monthly, starting July 1st, 2026. This is for access to Nvidia GP300 chips at SpaceX's Colossus II data center in Memphis. A move like this firmly establishes SpaceX as a primary compute landlord. By leasing out capacity to firms like Anthropic, Google, and now Reflection AI, SpaceX has amassed over $80 billion in committed third-party compute revenue. They are fundamentally diversifying their business model well beyond aerospace into heavy, utility-scale data infrastructure. In another major capital move today, ByteDance is currently in the market for a $20 billion denominated offshore loan, and this is its largest one to date. This debt is earmarked specifically for global AI infrastructure. The use of an offshore structure here is a highly calculated business decision. It gives ByteDance clean access to international banks, allowing them to fund overseas capacity and secure advanced chips, while navigating the complexities of their domestic credit channels and international export controls. On the regulatory front, we have a factual update regarding federal oversight. The Trump administration is actively pressing Meta to voluntarily submit its latest AI model, MuseSpark, for federal security evaluation. Reports indicate that Meta is currently the only major U.S. developer of AI technology that hasn't yet reached a formalized agreement to voluntarily share its models with the government for capability and vulnerability reviews. So, what is the cold business reality underlying today's headlines? Let's get into the analysts' take. We are witnessing a definitive transition in the market right now. We are moving out of the exuberance phase, which was characterized by software startups and highly speculative valuations, and we are firmly entering the infrastructure phase. This new reality is defined by massive debt financing, rigid power grid limits, and the rise of this compute landlord model we just talked about. The industry is treating intelligence less like a lightweight software product and much more like heavy utility infrastructure. And this creates a paradox that is currently acting as a real-time stress test for the market. On one hand, engineering milestones are absolutely peaking. We see that with exascale systems like China's LineShine and those theoretical roadmaps from DeepMind. But on the other hand, the financial structures supporting these achievements are facing severe strain, as demonstrated by the sudden semiconductor sell-off we saw overnight. The reality is, deploying intelligence at an industrial scale requires unprecedented capital expenditure, and the market is currently searching for a sustainable equilibrium between the cost to build it and the verifiable utility it provides. Looking ahead, the market is bracing for the next major catalysts that will test this equilibrium. The immediate focus for analysts will be the impending inclusion of SpaceX into the Nasdaq 100. This specific event is expected to trigger roughly $22 billion in mechanical buying of SPX stock by index trackers. Right after that, SpaceX's first public quarterly earnings are going to expose the actual hard burn rate of AI infrastructure. The question for the market is no longer how smart is the AI, but rather, will the recurring revenue ever justify the multi-billion-dollar capital outlays required to build it? The market is going to be watching the math very, very closely. That wraps up today's Explainer. Thank you for joining us for this grounded look at the market realities shaping the technology sector right now. This broadcast has been sponsored by bestai.org. Keep a close eye on the data as the infrastructure phase continues to unfold, and we'll see you next time.